Right now, crude is sitting near $90 a barrel. That price already reflects a powerful short-term rally, up over 20% in a single month. But beneath the surface, the market is trapped. Long-term forces like fiat money debasement and developing world urbanization are pushing it higher. Medium-term, a cost floor near $30 and a demand destruction ceiling near $150 keep it boxed in. Short-term, geopolitical supply expansions are trying to drive it down. The result is a four-dimensional puzzle that most commentary misses. Today, we strip oil pricing down to those four layers: ultra-long, long, medium, and short, and show why the real shock is not today's $90, but the supply crunch that is building for the end of this decade. Let's start with the deepest layer, the slow destruction of fiat purchasing power. 50 years ago, a barrel of crude cost $3. Today, nominal prices are 20 to 30 times higher. But the real shock is what happened to the currency itself. One $1,973 now buys only 17 cents worth of goods. So the majority of oil's price rise is not about the commodity becoming scarcer in absolute terms, it is about the denominator. All fiat currencies, including the dollar, leak value over time. For a non-renewable commodity like crude, an asset with no depreciation and finite supply, that currency debasement acts as a perpetual tailwind. The question is not whether this tailwind persists, but whether it can be temporarily masked by other factors. In the ultra-long run, the trend is set by the printing press. Before we can project demand, we must confront a hard physics constraint: energy density. A liter of gasoline packs almost 9 kilowatt-hours of energy. The best lithium-ion batteries today manage barely 0.7. That means for the same volume, liquid fuel stores more than 12 times the energy. This is not a technological shortcoming that incremental R&D will fix, it is a fundamental chemical limit. Compressed hydrogen gets to 1.4 kilowatt-hours per liter, but requires expensive carbon fiber tanks and a refueling infrastructure that costs 10 times that of petrol stations. These numbers explain why cargo ships, long-haul trucks, and aircraft cannot realistically be electrified at scale. And beyond fuel, the petrochemical derivatives, plastics, synthetic fabrics, agricultural fertilizers, still depend overwhelmingly on crude. The world may electrify city driving, but the industrial core remains chained to oil. The physics can be expressed as a simple range equation. Take a typical electric vehicle battery, 500 kilograms, storing at best 75 kilowatt-hours. That gets you roughly 300 kilometers. Now take the same mass allowance for liquid fuel in a conventional car, 50 liters of gasoline, packing 445 kilowatt-hours, 6 times the energy on board. That vehicle can cover over 2,000 kilometers without refueling. For a container ship crossing the Pacific, the battery required would weigh thousands of tons, devouring cargo capacity and cost. This is why, barring a revolutionary jump in energy storage physics, like solid-state lithium-air or nuclear microreactors, the core fuel architecture of global trade will remain petroleum-based through the 2040s. The market's periodic excitement about imminent peak oil demand ignores this gravitational pull of thermodynamics. The long-run demand story is written in city population projections. The United Nations expects 2 to 2.5 billion new urban residents by the middle of the century. Almost all of them will live in Asia and Africa. A city dweller consumes roughly 10 times more oil-embedded products, fuel, plastics, bitumen, synthetic fibers, than someone in the countryside. Think of China between 2000 and 2010, 200 million people moved into cities, and crude spiked from $20 to $147. That was a demand shock of 200 million. The coming wave is 10 times that magnitude. Today, however, we are in an interregnum. China's oil demand growth has cooled to under 1%. India, Nigeria, Indonesia, and Ethiopia are only beginning their urbanization trajectories. The locomotive is idling, but the loaded train stands ready. The demand picture is bipolar. In the developed world, transport fuel use is shrinking. The United States is 4% below pre-pandemic levels, Europe down 7%, Japan down 12%. Efficiency gains, electrification, and remote work are eating into the dominant fuel category. But in the developing world, every indicator points up. India alone added 3.4% to its oil demand in 2024, becoming the largest growth engine. Southeast Asia and Africa grew at 2 to 2.5%. And the crucial metric is per capita consumption of oil-derived products. High-income countries use 20 times more plastic and 10 times more fertilizer per person. As incomes rise across the global south, that gap will close, creating a structural lift that neither EV adoption nor efficiency can offset for decades. If demand will eventually roar back, the supply side is heading toward a wall. Global upstream capital expenditure is still running 60% below its 2014 peak. The industry earned an unprecedented $1.4 trillion in free cash flow during 2022, yet almost all of it went to dividends and buybacks, not new drilling. Management teams and shareholders carry the scars of the 2014 to 2016 collapse, when over 100 shale companies went bankrupt and the sector torched $300 billion of investor capital. The mantra today is, capital discipline, no unapproved expansion. But oil fields do not sit still. They naturally decline at 4 to 6% each year. Without constant reinvestment, the global production base is eroding. This is creating a structural supply void that no amount of short-term policy tweaking can instantly fill. We can capture the erosion with a straightforward production formula. A field's output declines exponentially by a few percent each year. To keep total output flat, new wells must offset that decline. If the investment required to drill those new wells is withheld, as it is today, then total production will eventually trend downwards. Right now, the global decline rate sits between 4 and 6%. That implies the world must add the equivalent of a major new oil province every couple of years just to stay even. The data show we are not doing that. The rig count, the discovery rate, and the final investment decisions are all running below replacement. This is the ticking clock beneath the placid surface of the current market. Not all barrels are created equal. The cheapest oil sits in the Middle East. Saudi Arabia can produce at under $10 a barrel, Kuwait and Iraq below $20. At the other end, American shale typically breaks even between $40 and $60, Canadian oil sands and Brazilian deepwater are even higher. These cost differentials create a natural floor for prices. Below $30, the expensive half of the world's production would shut down within months, exactly what happened in 2015 to 2016 when U.S. shale output collapsed. Supply contraction then forces a rebound. This is why crude has rarely spent sustained time below $30, except during extreme storage gluts like April 2020, when spot WTI briefly went negative due to delivery constraints. The floor is real, and it gives traders a probabilistic anchor. Look at the recent path of Brent crude. Over the past 60 trading days, the price has swung between $70 and $112, settling now near $90. That includes a blistering 25% rally in just the last month. The volatility is not random, it reflects the tug-of-war between short-term supply fears and the weight of potential new barrels from places like Venezuela and Iran. But note where $90 sits within the medium-term box, well above the production cost floor, but still a long way from the demand destruction ceiling near $150. The rally has been sharp, but it has not broken the box. It merely underscores how sensitive the market is to any supply interruption, and how much latent upside pressure exists. On the short-term horizon, the U.S. administration is engineering a multi-pronged supply expansion. First, Venezuela. With the political landscape shifting, American firms could eventually rehabilitate the decrepit oil infrastructure, but expect 3 to 5 years and hundreds of billions in investment. Second, domestic shale. Output is at an all-time high of 13.5 million barrels a day, and regulatory tailwinds are strong. Yet even shale needs 12 to 18 months from well spud to production. Third, Iran. Sanctions have already cut exports by 30%, and the administration is applying maximum pressure. If the regime ultimately crumbles, another 3.2 million barrels a day could enter the market, but that scenario is multi-year and fraught with risk. The combined effect is a slow, grinding increase in supply, which helps cap rallies but cannot trigger a sustained crash. Even when supply and demand fundamentals are balanced, crude carries a risk premium that waxes and wanes with headlines. We can think of the market price as the fundamental clearing price, plus a geopolitical tension surcharge. When Houthi rebels strike Saudi facilities, or when the Strait of Hormuz is threatened, that surcharge can spike to $10 or $20 a barrel. In 2019, a drone attack on Aramco caused a single-day 15% jump. In 2024, Red Sea disruptions doubled shipping costs and injected a persistent premium. Today, the tension index is elevated but partially offset by expectations of future supply. As those expectations materialize, or fail to, the premium will swing. This formula helps separate what is temporary from what is structural in the day-to-day price. Let's stack the 4 layers. At the base, fiat debasement provides an inexorable upward drift in nominal oil prices, as long as crude remains an essential, non-renewable commodity. On top of that, a 2 billion person urbanization wave is rolling toward the middle of the century. It will replicate China's demand explosion, but on a larger scale. Medium term, the industry is trapped in a box, a cost floor near $30 and a demand ceiling around $150, with both supply and demand too anemic to break out. Short term, geopolitical moves to bring new supply online keep the pressure on the downside. But here is the insight: the chronic underinvestment of the past decade has hollowed out the supply fabric. By the time the urbanization locomotive hits full speed around 2030, the world will face a gap between what it needs and what it can produce. That collision will break the box, to the upside, violently. Oil markets are a kaleidoscope of timescales. The daily noise tempts us to overreact to every pipeline disruption or political tweet. But the durable forces are slower and more powerful: the printing press, the city, the bankruptcy scar, and the years-long lead time to bring new fields online. Right now, those forces are compressing the price into a box, but they are also winding a spring that will release when the developing world's demand for liquid energy finally catches up with an exhausted supply base. The framework we've set out doesn't predict the exact month, but it does tell you the direction of the breakout. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.